Hi everyone, and welcome to our webinar about legal aspects and business management tools when creating a company. This webinar is the Module 4 of the entrepreneurial training course of the SPINTeams project. I'm Antoni Munuera. I'm economist and responsible for business promotion programs of the Chamber of Commerce of Terrassa. I've been working in the Chamber of Commerce for 24 years and I'm in charge of the promotion business department and advising entrepreneurs. The decision to create a company is not usually an easy task. Entrepreneurs can often have a good idea, but probably they don't know where to go or how to start. It's easy to forget that before starting a business project, it must be evaluated for having a valid criterion about its viability. In general terms, we can say that there are two types of new entrepreneurs: the necessity new entrepreneur and the opportunity new entrepreneur. The new entrepreneur by necessity is usually a person or several people who are facing an unexpected situation, for instance, employment. To create a new business can be seen as an easy and fast way to solve this situation. There is nothing more far from reality. On the other hand, the opportunity entrepreneur is that person or group of people who, for some reason, want to start a business based on a technical innovation, a new idea, or have detected a market niche. The new business will solve problems or will satisfy needs of potential customers that currently are not covered or just partly covered. From a risk point of view, and always speaking in general terms, projects with not enough preparation have a higher risk of failure. In this sense, projects driven by necessity are usually prepared as a matter of urgency, and then they have a higher risk to fail than projects driven by a genuine new business idea. The motivation is different, so the entrepreneur by necessity must be aware that it's necessary to work more deeply to be successful. In any case, before starting a new business, it's needed to have certainty or to reduce the risk to a minimum to ensure its viability. And as seen in Module 2, the tool to ensure the viability is the business plan. But in addition to business plan, it's recommended that new entrepreneurs also have at least a basic knowledge of aspects not directly related to the activity to be promoted, but related with legal aspects, accounting and financial management, tax and social security obligations, liability to third parties, etc., that in some way can also condition both the viability of the project and its future management. It's also very important to define the relationship between partners, the function they are going to perform in the daily work of the company, and how the strategic decisions are going to be made. In this webinar, we're going to follow the next scheme to try to introduce the most important concepts related on legal aspects and financial management tools that you must take into account before starting your business. First, we're going to talk about the most common legal forms and the implications of choosing one legal form or another. Once the legal form is chosen, we're going to see that this has consequences with tax and social security obligations, and as well on the responsibility that new entrepreneurs will assume depending on the legal form chosen. Next, we will talk about how to evaluate the economic and financial viability of the company, and finally, we will explain what management tools exist to have knowledge about the evolution of the business and for being able to make decisions in accordance with this evolution. Let's start talking about the legal forms for creating a new company. To start a business project, it will be necessary to create a company with a specific legal form. The choice of legal form will basically depend on the number of people who are going to lead the new business. If the business is promoted by a single person, the most common legal form is the self-employed new entrepreneur. That means that it's the individual person who carries out the activity. If there is more than one person as entrepreneurs, it will be necessary to establish some type of company that links all the partners on the new business to be created. In this case, the most common legal form would be the limited liability company. If the decision has been to create a limited liability company, it's very important to decide the participation of each partner in the new company. This is a very important aspect in case that the new business project is promoted by more than one person, and mainly if the entrepreneurs are just two. In this case, when there are two partners, it's common to think that the ideal participation for each partner would be an equal division of the company with a 50% of participation for each. We may think that this would be a good decision, but in the future, it could be a main source of conflicts. In case of disagreement between the partners, the company will be blocked and no decision could be made. To avoid this, it could be better if the percentage of the participation between the partners was different. For example, 51-49 for each partner. Probably, this is one of the most delicate decisions to make, as no partner will want to be less influent in the decision-making process than the other, but surely it's the best decision for long-term partnerships. In any case, it's important that the sum of participations between different groups of partners does not result in a tie, for example, 50-25-25. In this case, the distribution of shares of 51-25-24, for example, would be more convenient. Another important aspect to take into account is the internal organization. This is also a key aspect that should be discussed among the partners on the future company. It's important to decide which areas of company management will be the responsibility of each partner: sales, manufacturing or customer sales, service, internal management, etc. These responsibilities can be decided based on the knowledge, skills, experience, and preference of each partner. In the event that any management area remains to be uncovered by partners, tasks and skills could always be subcontracted, or new personnel could be hired to cover those functions or skills still uncovered. Many startups and new companies fail because they not have previously planned or decided these key elements. All these aspects must be considered and decided during the development of the business plan. In any case, the choice of legal form will depend on the legal framework of the country where the new company is going to be established, and therefore it will be necessary to know the legal framework and adapt to it. Once the legal form has been chosen, we must be aware of the obligations or consequences that are derived from the legal form chosen. An important aspect is the responsibility. Although this is an aspect that will depend on the legal framework of each country, usually the responsibility of self-employed new entrepreneur is usually unlimited. That means that the new entrepreneurs respond with all his assets in the event of possible eventualities. There is no separation between personal assets and business assets. On the other hand, in the case of commercial companies, the partners respond to possible eventualities for the value of the capital contributed to the company. In this case, it exists a separation between personal assets and company assets. Another point to consider when creating a new company is the capital. The capital contribution to the new company will also depend on the legal form chosen, and once again, it will also be necessary to adapt to the legislation of each country. In general terms, if the legal form chosen is the self-employed new entrepreneur, it will not be necessary to make a minimum capital contribution. On the other hand, if a commercial company is the legal form chosen, it's usually obligated to make a capital contribution. This contribution should not be confused with the initial investments to start an economic activity. And this is an amount of money that should be used for the future management of the new company. And finally, there are formalities to do for creating the new company. The formalities to create a company will also depend on the legal form chosen for the management of the new company, and obviously also on the legislation of each country. Related to this, there are different initiatives that can simplify the procedures and make shorter the term to formalize the constitution of a company, such as the one-stop shop. Let's now to talk about the tax obligations. Taxes can have significant implication on a business cash flow or liquidity. It's vital to understand and plan the impact of taxes on the cash flow, and for this reason, it's important that you register in your accounting the taxes properly. All companies that develop an economic activity must comply with the corresponding tax obligation. Once again, this obligation will depend on the legal framework of each country, but in general, the most common obligations are as follows. First of all, we are talking about taxes on profits generated. This tax is generated by the fact that a company earns money, and each payment will depend on the legal form chosen to carry out the activity. Periodically, the amount of the profits generated must be communicated to the tax agency, and a percentage of it must be paid, which will depend on the regulation of each country and on the legal form chosen. Another tax obligation is about VAT. VAT is an indirect tax and usually is quite complex. Summarizing, and in general terms, consists of adding a percentage to the concepts invoiced. Periodically, normally quarterly, the difference between the VAT invoiced to customers and the VAT invoiced to us by suppliers must be reported to the tax agency. This difference is usually positive and must be paid to the said tax agency. Another obligation that all companies must comply with is to pay a fee to the Social Security. Social Security is an organization that, among many other functions, is in charge of managing health services, covering payments for sick leave, and paying pensions to retired people, among other functions depending on each country. All companies and the new entrepreneurs must pay a fee to the Social Security. This fee can be a fixed fee or based on the income or profit obtained during a period of time. The payment of the fee is usually monthly. Once again, the current legislation on this matter must be complied with in each country where the economic activity is carried out. Once all the legal framework is learned, let's talk now about how to assess the viability of a business project. The appropriate tool to assess the viability of a business project is the business plan. That it was explained on the Model 2 of the entrepreneurial training course of the SPINTeams project. The business plan is the result of a process of analysis in which various aspects related to the future business activity are analyzed. An important aspect to analyze is the future economic and financial viability of the project. And what is the usual way for evaluating the economic and financial viability? The answer is to make the financial and economic plan. For doing this, the first step to follow is to assess the investments needed to start the activity. An inventory should be made of everything necessary to start: machinery, installations, IT equipment, vehicles, furniture, raw materials, etc., and assess the amount of money that will be needed to acquire each of these elements. Once this investment has been valued, the source of financing to be able to carry out these investments must be evaluated. The different sources of financing can be: own funds is the financing provided by the partners of the company or the new entrepreneurs team or partners. Bank loans, it's the part that will be obtained from a financial entity or bank to cover the necessary investment for starting the activity. Public aids, aids from the government for starting a new company, for example, an interest subsidy on the request bank loan. And subventions, that is an amount of money that is given to new business to help them during the first month or years of activity, and it's not necessary to repay. And then the evaluation of the economic viability will be carried out by making a forecast of income and expenses for the first month of activity. To do this, we must follow the next steps. First of all, we have to evaluate the fixed cost. They are costs that do not vary regardless of the volume of sales or turnover. For instance, an office monthly rent is a fixed cost. Then we have to assess the variable cost. They are costs that increase or decrease depending on the volume of sales or turnover. For example, the consumption of raw material is a variable cost. Then we have to calculate the break-even point. That is the minimum sales level that equals total cost to total income, is the zero profit and zero losses point. And finally, we have to assess the period of time that it will take to reach the break-even point. It's desirable that the period before reaching the break-even point was as short as possible. While this point is not reached, the company won't obtain profits, and therefore it will be necessary for the new entrepreneurs or partners to contribute with extra funds in order to cover the losses generated. This quantity of losses must be added to the previously calculated initial investments. Once we have started the new business, we are expert on its field, but it will be necessary to have a minimum knowledge about the financial management in order to control the evolution of the business. It will be necessary to have tools that help us to monitor the economic situation of the company. The best tool for this is accounting, since it allows us to get important data to know the evolution of the business, and we will be able to make decisions in accordance with this evolution. The accounting is the tool that all companies must use to monitor the evolution of the business. Usually, there is an obligation to keep accounting records, but this depends on the law of each country. Not all companies are obligated to, but it's highly recommended that every business and new business keep accounting records in order to monitor the business performance. In any case, accounting must be adapted to what is established by the regulation of each country. From the accounting, all the company's managers can use different tools that can help them to make different decisions about the business. Let's see what the tools are. The first tool we can get from the accounting is the balance sheet. The balance sheet is a document that represents the true and the real image of a company for a period. It's generated from the information provided by the company's accounting, which contains data from the past, the present, and even data forecast for the future. Summarizing, the balance sheet shows the financial situation of a company. The balance sheet reflects data about the rights and possession of the company, called assets, and the liabilities and the shareholders' equity. The assets portion of the balance sheet goes into what the business owns that can be converted to cash. Assets can further be broken down into two subcategories, such as current assets and long-term assets, or also named non-current assets. The long-term assets or non-current assets are assets that required more than 1 year to get their money's worth. They are buildings, equipment, properties, machinery, IT equipment, etc., owned by the company, and also intangible assets such as copyrights or patents. Current assets are assets that can be converted into cash in less than 1 year. They are investments that can be sold in less than 1 year, accounts receivable, money out by clients, the inventory, and obviously the money in bank accounts and the cash. The liabilities and owner equity show the source of financing that serve to maintain all the assets we have seen before. It's divided in owner's equity, non-current liabilities, and current liabilities. Owner's equity, or also named shareholders' equities, are formed by the capital contributed by each partner and the amount of money that is generated by the business during previous years. The liabilities refer to money that is owed to others, for example, loans. Like asset, this category can be broken into the two subcategories of current liabilities, such as payment to suppliers and other accounts payable, and long-term liabilities. The long-term liabilities section classifies all those debts whose payment date is set for a period of more than 1 year, from the date of preparation of the balance sheet. For example, a balance formulated in December 2021 could show debts with a payment date beyond December 2022. On the other hand, the current liability section classifies all those debts whose payment date is set for a period of less than 1 year, from the date of preparation of the balance sheet. For example, a balance sheet formulated in December 2021 would show debts with a payment date prior to December 2022. Usually are formed by payments to suppliers and other payable accounts. Another tool that can be got from the accounting is the profit and loss sheet. A profit and loss report is a financial statement that summarizes all the expenses, costs, and revenues of an organization during a particular period of time, often monthly. As the balance sheet is generated from the information provided by the company's accounting. The profit and loss report is usually divided into two sections, revenue and expenses. Revenues refers to income from all the activities of the company. It's the amount of money obtained by the companies from their sales. Expenses are referred to all expenditures, and there are different classes of that, and usually are shown in the following order. The cost of goods sold, for example, any raw materials, the staff cost, the operating expenses, as rent, office supplies, utilities, telephone, insurance, travels, advertising, etc., amortization or depreciation cost, financial cost, financial income, other expenses, and corporate taxes. From the income and the different types of expenses or cost, we can obtain different types of margins or subtotals, as is shown in the slide. The different levels of results show the reason why a company is viable or not. For example, if we subtract the cost of those sales from the sales, for example, if we sell candies, we should subtract the cost of the raw materials that have been used to make what we have sold, we will obtain the gross margin. If the gross margin is negative, it indicates that the core business of the company is not viable and that the business model should be reviewed or even be closed. The EBITDA shows the profit that is obtained after subtracting the cost of the structure necessary to manage the company. If the EBITDA is negative, it means that the company should review personnel costs and management expenses. Probably, the personnel structure is oversized and so are the management expenses. The business is viable in itself, but the structure that manages it must be reviewed. The EBIT shows the profit that the company obtains after subtracting the expenses for the amortization of the assets elements that the company uses. If the EBIT is negative, it will indicate that the company is working with oversized assets, machinery, installations, etc., and that it should be adjusted to the real needs of the company. The EBT shows the benefit that the company obtains after applying the cost generated by the external financing source used by the company. For example, the blank loans. If the EBT is negative, it indicates that the company is bearing an excess of financial expenses due to an excess of external financing. In this case, it should restructure the source of financing, reduce external debt, and increase own funds. On the other hand, if it obtains a positive result after obtaining a negative EBIT, it will indicate that the company generates profits from financial management, and therefore it could be understood that the company's business is different. And finally, the net profit shows the profit or loss generated after the tax income is paid. And it's also important to consider that the profit and loss sheet can be compared with the profit and loss sheet at the same time, at the same period of the previous year and with the budget. Once we have seen what the profit and loss is, let's talk about the treasury control. The treasury control or cash flow control is another tool for the financial management. This is important for all companies because we must distinguish between income and collections and between expenses and payments. These concepts are often confused and therefore we must be clear about each of them. What's an income? The incomes are generated at the time of using an invoice and making the corresponding entry registered in the accounting in the profit and loss account. What's a collection? The collections are generated at the time in which a flow of money is received from a client who previously has received our invoice. Because there may be a time difference between the time an invoice is used and its subsequent collection, it's important to differentiate income from collections. What are costs or expenses? They are generated at the time of receiving an invoice from a supplier and is recorded in the accounting in the profit and loss account. What is a payment? The payments are generated at the time in which a flow of money is sent for paying an invoice previously received. Due to the fact that there may be a temporary difference between the moment of receiving an invoice and its subsequent payment, it's important to differentiate expenses from payments. Based on this information, all expected receipts and payments must be classified over a period of time, for example, 1 year, classified by month. In this way, it's possible to see if any month the expected payments exceed the expected collections, so that measures can be applied to avoid this situation. And finally, we're going to talk about the budget. The budget is an instrument that should serve to detect desviation in relation to the forecast made previously on the expected income and expenses. It's usually carried out for a period of 1 year and periodically, every month, for example. Its evolution must be analyzed, deviation detected, and the corresponding decisions made in each case. We have tried to introduce the most important and strategic concepts on financial management that you will need to know before starting your business. I hope that all this information be useful in your projects, and if you have any doubt or question, don't hesitate to ask me through the Rebel-based platform. And don't forget to fill out the form at the end if you are interested in receiving your certificate. Thank you for your attention. Bye-bye.